Welcome to, I guess, the second part of this 5471 series. Um, Basically, with the whole point of this series is really to familiarize you with the Form 5471 and some of the technical aspects associated with it. But really, more importantly, to be able to confidently prepare the form in some of the more common situations, and know what you don't know at the end of the day. Know what questions to ask and when you need to go look something up. So that's kind of the point of this whole series. And it's focused on normal 5471s, not big, huge multinational corporate type 5471. So the first part of the series was really focused on an overview of the form itself. So if you remember, if you were there, the first thing we talked about was the entity classification rules. So when do you have a foreign corporation? And from an IRS perspective, and what ability do you have to manipulate that classification? Can we make check the box elections to make it a flow through? When would you want to do that? So we talked about that, and then also with we talked about some of the key definitions around the Form 5471. So, what is a controlled foreign corporation? Who is a U.S. shareholder? Some of the constructive ownership rules. And then we looked at the form itself. We looked at when do you have to file this form? What are the filing requirements and the specific categories of filer, and the different schedules you have to provide depending on the category. So that was part one, really looking at the overall framework. So now in part two, what we're going to be focusing on is the what I call doing the work. So preparing the actual form. So I'll put together basically a variety of scenarios that I think are the most common that I see, at least, and we're going to walk through the form itself to prepare the form. Make sure. Sorry if my internet blinked out. All right, so next slide. So the agenda, like we said, I'm going to do a quick review of what we talked about in the first part of the series, just because I want to really solidify that, and for the benefit of people who maybe didn't see the first part. Just because if you miss that, it's really the rest of it doesn't matter, because if you miss the classification, then you've missed it all, basically. So we're going to go over a quick review, and then we're going to get into some of the new concepts. So I'll look at some of the technical aspects of, that are relevant to the forms we're going to look at, or the examples. And really the whole thing we'll be looking at is GILTI, because it's so pervasively applicable when you have a controlled foreign corporation. So we're going to look at the definition of GILTI, how it's calculated, and what are some of the exceptions associated with it. And then we'll jump into the actual examples. Basically, I have 5 examples. The first 2 we'll spend the majority of the time on. They're basically just a individual owns a foreign corporation and has a GILTI. So we'll look at preparing that form, and then a similar scenario, but with an S corp or a partnership owning the foreign corporation. And then the other 3, high tax exception, and some of these more specific, category 2 and 3 and category 4 filers only. Just some technical nuances with how to prepare those types of forms in those situations. All right, so let's jump in. So the first part of the review. So again, we talked about the entity classification rules, and the important thing here is that when you're dealing with a foreign company, it's generally a foreign limited liability company is going to have the opposite default rule as a U.S. limited liability company. A U.S. LLC defaults to a flow through. You can elect to make it a corporation, right? A foreign LLC is going to default to a corporation, and you can generally elect to treat it as a flow through. So, basically, if you have a client that owns a foreign company, the first thing you need to ask is, what is the legal entity type of that company? So the foreign jurisdiction, what do they call this company? And then you need to look it up and see, do they provide limited liability protection to all of its owners, because that's really the distinguishing factor between corporate or not. And so if it does provide limited liability to all the owners, then it defaults to a foreign corporation. If it doesn't, then it defaults to a flow-through. So if it's a defaulted to a corporation, the next step is, do you want to make sure that, or you want to see if it's a per se entity, meaning that you cannot elect to treat it as a flow-through. And there's a specific list in -2B8 that I've listed here. So you just check that list to see if that entity type's on the list. If it's not a per se company. So now you have an eligible entity. So then it comes down to a decision as to whether it's better for that particular taxpayer to have a flow-through or a foreign corporation. And again, remember, it's tricky if this company's been in existence for a while to then make a check the box selection, because you have a liquidation event and sales. So, you have to look out for that. But that's really the steps to look at. And then obviously, if you're going to make that check the box selection, there's procedures. There's 8832. You got to do it within a certain time limit. And all that's in the other slide deck. So that's the entity classification rules. And then, we looked at important definitions. So the two main ones here are controlled foreign corporation and U.S. shareholder. So a controlled, and it's always hard to say this because it sounds confusing when I say it out loud, but a controlled foreign corporation is you have a controlled foreign corporation when more than 50% of the shares, vote, or value is owned by U.S. shareholders. And U.S. shareholders are only your 10% people that own 10% or more of the company. So what that means is if you have 11 U.S. shareholders with equal ownership, then none of them have at least 10% of the stock ownership. So in that case, there's no way you can have a controlled foreign corporation because there's no U.S. shareholder from this definition's perspective. So those are two critical definitions. And then again, we have these constructive ownership rules where you can be deemed to own the stock of, a related person, say a family member. So, even if let's say you owned 8%, but your brother owns another percentage, you could be deemed to constructively own that percent for purposes of some of these filing categories. All right, so those are the definitions we went over. The last part of this review is just, the first page of this form itself. So, we looked at who has a filing requirement, and that comes into these categories of filers here. And remember, we talked about category one. Category 1A has to do with the transition tax, which really shouldn't be applicable in most cases with, current year tax returns. And 1B and C have to do with these goofy downward attribution rules, which is a very specific fact pattern that we're really not getting into here. But the important things to remember with these filing categories is that, first of all, there's a chart that tells you what schedules you have to include on your on the 5471, depending on your category. And the magic numbers you need to look at, or one of them is this 10% threshold. So if you have a U.S. person that crosses that 10% threshold, so either they acquire an interest that gets them over 10% interest in the foreign company, or they dispose of an interest that gets them under 10%, that's what triggers that category 3 filing requirement. And so you can have that whether it's a controlled foreign corporation or not. And we'll look at an example of that. Category 2 has a similar rule with that 10% threshold, but it's only on acquisitions, and it only applies to directors and officers of the company. Category 4 is where you have control. U.S. person has control of that company. So that shareholder itself has more than 50% ownership in the company. It has control. And then category 5A, that's where you have a controlled foreign corporation. So category 5A is the one that's going to trigger GILTI. If it's not category 5, it's not a controlled foreign corporation, and GILTI is irrelevant. So those are the filing categories that we're dealing with. And in all the cases, or at least these GILTI cases we're going to be going through, we're always going to be looking at category 4, or at least it's always going to be category 5A, showing that it's a controlled foreign corporation. And remember, category 5B and 5C, kind of like 1B and 1C, that has to do with those downward attribution rules that we're we're skipping over at this point. All right, so that's basically the review. That's the overview of 5471 and the filing requirements. So the new concepts that we're going to get into today really has to do with GILTI. That's the main concept because that's what's driving a lot of the nuance at this point with the foreign corporation filings. So what is GILTI? GILTI stands for, like I wrote here, Global Intangible Low Taxed Income. It's a mouthful, but to really understand what GILTI is, I think it's important to go back. I think you have to understand what the rules were prior to the Tax Cuts and Jobs Act and how GILTI changed that. So basically, prior to the TCJA, you had this concept of deferral, and that concept's still there, but it was more prevalent then. But the old rule was basically if a U.S. shareholder owned a foreign corporation, it didn't have to pay tax on the income earned by that foreign corporation until it brought the money back or the earnings back as a dividend. So it paid tax on the dividends from the foreign corporation. Now and that's the concept of deferral. And that's, so you had this big lockout effect where these big, mega multinationals would just keep foreign earnings abroad because they didn't want to bring it back and pay tax on it. And there were still anti-deferral rules like Subpart F, in 956, some other things that could trigger U.S. tax on current income, but they were relatively easy to maneuver. I mean, or at least easier than GILTI. So that was this lockout effect or deferral that was applicable prior to TCJA. What happened with the TCJA was that basically the law said that U.S. corporations can now bring that money back to the U.S. so they can distribute the earnings back to the U.S. shareholder, and a U.S. corporate shareholder wouldn't have to pay tax on that distribution. That was the carrot, basically, to get the money back to the U.S. The stick was GILTI. So GILTI was basically, it said, you can bring that money back, but going forward, you're going to be taxed. We have a new anti-deferral rule on top of Subpart F that is going to tax you on what we deem to be intangible or income earned from intangible assets. And the way they define income from intangible assets, or the way they define GILTI, is the net income of the business less a 10% return on your depreciable asset basis. So if you have a company that, and I'll show you like kind of a quantitative example of this, so maybe it sinks in a little better. But if you have a company like a service-based company, which is what I see a lot on the smaller scale side of 5471s, people that maybe it's an expat or somebody that has a foreign company, and it's a service business. There's probably not a lot of assets. So if there's no fixed assets as they're depreciating, then from the IRS's perspective, all of the net income is coming from intangible assets. So it's all subject to GILTI. So that's the basic rule. And GILTI kind of works in a hierarchy. So like in the second bullet point, you have to work through, there are certain exemptions from GILTI, and they have to do with usually, things like, so there's still Subpart F that exists. So if the company is subject to Subpart F, then that comes first before GILTI. So if they're already taxed under Subpart F, the IRS ain't going to tax them again on GILTI. So that gets exempted out. And the same with ECI. ECI would basically be if the foreign company had a U.S. trade or business and it's earning U.S. taxable income. So it would file an 1120-F. If it's already subject to U.S. tax on that income, they're not going to hit them again with GILTI. And there's also this high tax exception, which we're going to talk about in more detail in a bit, but basically, so the first thing is there are exceptions from GILTI that get run through, but then if those aren't applicable, or to the extent there's leftover income that is subject to GILTI, that's where the rest of these rules kick in. And the last thing I want to point out before we get into some more examples, there's a difference between the way GILTI applies to a corporate shareholder versus a U.S. shareholder, individual shareholder. And today we're really focusing on individual shareholder. But I just wanted to point out this distinction, and it works very similar. The idea is very similar to a U.S. ownership of a U.S. corporation. If an individual owns a U.S. corporation, there's always double tax, right? The U.S. corporation pays tax, then it pays a dividend up to the shareholder. Shareholder pays tax on the dividend. If you have a U.S. corporation that owns another U.S. corporation, there's a dividends received deduction, so there's not that double tax in that scenario. And it's kind of the same thing when you own a foreign corporation. So if it's an individual, it would be subject to GILTI, and the distribution is going to be taxable. I'm sorry. I guess the point of this is kind of about the foreign tax credit and how it applies. But if you have a foreign corporation owned by a U.S. individual, that foreign corporation may be in a jurisdiction where it pays tax. And if it's already paying tax and it's subject to GILTI, an individual shareholder is generally not going to get a credit, a foreign tax credit against that income. So there is going to be some double tax there, which is similar to how there's double tax in a U.S. shareholder scenario. And then if you have a corporate shareholder, a U.S. corporate shareholder, that is different in that the U.S. corporation, if it owns the foreign corporation and the foreign corporation pays tax, the GILTI in that scenario is creditable by the U.S. corporation. You get 80% of the tax, basically. So if the foreign corporation is paying a 10% tax rate, the U.S. is going to be able to apply a foreign tax credit to 80% of that. And there's also a 50% deduction that it gets on that GILTI amount. So you actually get a better deal with GILTI than you get with Subpart F, although Subpart F comes first. So you still, in some cases, want to avoid Subpart F. But in the individual scenario, you don't generally get that foreign tax credit or that 50% deduction. So one option you have, which will be kind of the basis of another part of the series, but an individual can make what's called a Section 962 election. And what that does is it treats the individual as a U.S. corporation solely for purposes of GILTI. So when you calculate the impact of GILTI on the individual, it's going to allow that foreign tax credit and the 50% deduction. And you actually include the certain corporate forms on the individual's return. And there's a catch to it because we'll talk about previously taxed income, because then when you make a distribution, it's still going to be taxable. So it's not always beneficial to take that 962 election. It kind of depends on the situation. But that's basically how GILTI works. And we're going to go through the example, obviously, to help. But just a very simple numerical example of how the calculation works. If a CFC has tested income of $150,000, and we'll talk about the definition of that, but it's essentially the net income of the foreign corporation with the appropriate books tax adjustment. So U.S. taxable income of the CFC. If that number's $150,000, they have depreciable property with a basis of $500,000. You take 10% of that $500,000, that NDTIR, the net deemed tangible income return, is $50,000. So you get a deduction of $50,000 in that case. So instead of your tested income in this case, which ultimately would be the GILTI, instead of it being $150,000, you get that $50,000 deduction. So the GILTI amount is $100,000. That's a basic example of just of how it works numerically. All right. So the other thing we're going to be looking at today is one of the major exceptions to GILTI and Subpart F as well, is the high tax exception. And this has some nuance to it, obviously, especially if you're talking about companies that have multiple CFCs and groups of CFCs. But for our purposes, the main point of this high tax exception is that if they're paying enough tax, if the foreign corporation is paying enough local corporate income tax, then the IRS says you don't have to pick up GILTI or Subpart F. And that magic number right now is 18.9%, because the code section says that it's 90% of the highest corporate tax rate, which currently is 21%. So that's a moving target, right? Like if right now this applies to a lot of countries at the moment. I mean, the UK, Canada, New Zealand, Australia, Mexico, they all have corporate tax rates above this 18.9%. So in a lot of cases, you see this high tax exception apply, which is why we're going to go over an example of what that form preparation looks like. But it's a moving target. I mean, if we change, if the corporate tax rate, back when it was 35%, that number is a lot higher, right? So this won't always come into play, and we have to keep our eyes on it. And I left a link here that just gives the corporate tax rates around the world, because that's generally the first thing I'll check a lot of times is what tax they're paying, what's the corporate tax rate in that local jurisdiction, so I can kind of compare. But when you have the high tax exception, we'll talk about the form preparation itself, but I'll put an example of the statement that needs to be included in the tax return to make that exception, basically. All right, so let's jump into the examples themselves. So the first one is, again, we're going to do two examples here with just a shareholder of a controlled foreign corporation that's subject to GILTI. So I'm basically going to show how the 5471 is prepared in this GILTI scenario and kind of talk through some of the nuances associated with it. Let's see. So in this first one, we have a U.S. individual that owns 100% of a controlled foreign corporation. I'm going to skip over page 1 because we kind of already talked about that. It's going to be a Category 4 and a Category 5 filer. Category 5 being it's a controlled foreign corporation, and 4 being that this taxpayer has control more than 50%. In this case, 100%. So that basically means all the schedules apply, except for Schedule O, which is the Category 2 and 3. So I'm going to walk through basically the relevant schedules. I'm not going to hit every single schedule. There's more, like the balance sheet's important that you have to put in there, and there's some other schedules, but really the important one, so that I want to show how it flows, basically, how it flows through the 5471 and then onto the individual's tax return at the end of the day. So that's the purpose of both of these two examples we're going to go through, is basically show the inputs and the flow of the P&L or the net income through the 5471 and how you come up with GILTI and put it on the return itself. All right, so in this case, the first schedule I want to look at is the income statement, Schedule C. And this is the company's profit and loss statement on a book basis. So this is, it doesn't matter if the person owns 50%, 75%. This is the company's 100%, 12-month financial statement or P&L. And so in this case, the left-hand side of this is your functional currency, and then the right-hand side is your US dollar amount. And ignore I called it a UK corporation here, but you'll see that the exchange rate is definitely not the UK exchange rate. So just kind of ignore that point, but it's irrelevant to the concepts. But in this case, the first thing I do, like if I'm reviewing one of these forms, first thing I do is I like to look at the net income and the taxes that they're paying, at least on a book basis. So remember, again, if this is an accrued-based company, these are GAAP principles that this is on, or IFRS, I guess. So we can't use that necessarily as a number that the tax that was actually paid, but it gives us a good idea, right? So I like to look at the tax number. Here we have about a 10% effective rate that looks like they're booking as an expense. And then I like to go to the chart to see what is the tax rate in that foreign country, because usually I want to understand when there's a discrepancy. And there could be a number of reasons, right, that there could be a discrepancy. There could be book tax differences, which is a lot of times the case. Net operating losses can trigger, a company not to pay any taxes, and you wouldn't necessarily see that on the P&L. So just things to be aware of. And that's why I generally ask for when I'm doing a 5471, I want to see the financial statements as well as the corporate tax return. So Any other points? Yeah, so that's the Schedule C. So from there, once we have the P&L, we take that information and put it on this Schedule I-1. And this is basically the form that calculates GILTI, or more specifically, tested income. Because, and we're gonna talk a lot more about this in a minute, but with each controlled foreign corporation, what we're coming up with on the Schedule I-1 is the tested income or the tested loss of that company. And then when when you're determining if you have GILTI is done on a, I don't know if this is the right word to use, but a consolidated basis. So if an individual owns multiple 5471s, GILTI is not calculated on each specific one. Tested income and tested loss are calculated on each specific one, and then you pull them all together to see what your net, if you have a net GILTI amount. So this Schedule I-1 is coming up with your tested income or loss. And one major thing to point out here is that before I showed you the P&L, the tested income or loss is calculated on a U.S. tax basis. So really, you kind of have to do a side calculation for your Schedule I-1 to make your book tax adjustments, just like you would for a U.S. corporation or U.S. company. You got to get to your U.S. taxable income number, and that's your U.S. tested income. But the first step is you have your U.S. gross income based on a tax basis. And in this case, there's no book tax differences, so it'll all tie out. And that may be the case, but you have to do that analysis. But we take the gross income, and then we talked about this earlier where there's these exceptions here. So the first thing we have to figure out is there any ECI? So what is it subject to U.S. tax? Is it a U.S. trade or business? That's pretty rare. So you don't see that a lot. Is there Subpart F income? We have to determine first if there's Subpart F. And I said earlier it's easier to plan around, and there's different categories of Subpart F. The one that you're going to see the most that you need to look out for is investment income. So if you have a controlled foreign corporation that earns passive investment type income, that's generally going to be Subpart F first. There's exceptions to it, so you have to kind of dig into that to see if it actually is Subpart F. But if there is Subpart F income, that comes out first. So let's say all of this was investment income subject to Subpart F, you would back it all out here, all of the gross income, and you would have zero tested income. So then we don't have to worry about GILTI. If you had some Subpart F income, it gets a little tricky because then you have to back out some of it. So then you have some Subpart F and the rest is GILTI. But here we're saying there's nothing but tested income. None of these additional exceptions apply. So the next step is to come up with your deductions that are allocable to your tested income. In this case, it's all of them because all of the gross income is tested gross income. So we just pull all the deductions over. Like I said, if you had some Subpart F income, you'd have to allocate deductions to both. You couldn't take all the deductions against the GILTI necessarily. You'd have to put some against both. So there's an allocation to do. But in this case, and in most cases, honestly, it's all going to be GILTI or tested income. And that number includes the tax expense. I see that a lot when I review this because they break out a whole nother line for the tax line, but line 6, I think it is. Line 7. Line 7, they break out the tax separately here, but it's also included in this number. This net tested income number includes your taxes. So like 178 was the net amount. Let's see. Well, yeah. Well, now I just noticed that that's a mistake on here because that 178 should include the taxes. Actually, that should be a 170. So that's my fault. But that's one of the things I'm usually looking at when I review this is that net number. So these deductions needed to have included the tax amount. So you'd have, your tested income includes taxes, then you break it out again here. And then in this case, we actually have what's called qualified business asset investment. So your QBI. So before I talked about your GILTI is the net tested income less a 10% return on your fixed assets. So The fixed assets, that's what they call this QI, qualified business asset investment. So in this case, the fixed assets we're applying here is 113,000. So we're going to have, these are the US dollar equivalents. So this will flow, and I'll show you how it flows to the actual 8992 when we calculate the GILTI amount. But that's important in determining that. And there's some other stuff here with interest expense and interest income. I'm not going to get into that because it's a little, we get too bogged down, but that could play a factor in this, but usually a smaller one to the net interest expense or net tested interest income. But that's basically how this flows. You come up with your net tested income amount and your qualified business asset amount. Those are the numbers we need to come up with our GILTI. So then once we've done the Schedule I-1, we're going to, the next thing I'll look at is the Schedule J. So the Schedule J is the earnings and profits of the entire foreign corporation. So it doesn't matter if your shareholder is, 100% owner or not. This is the company's E&P. So the first thing we need to understand this concept of E&P, and we talked about before this lockout effect, or the deferral, and the whole point of earnings and profits or E&P is to come up with the amount, or to track the amount that's available for distribution from the company. And just like with the U.S. corporation, there's ordering rules on distributions. It first comes out as a dividend out of E&P, and then it's return of capital, and then qualified dividend. So the point of this E&P tracking is so that we know when there's a distribution, whether it's a taxable dividend or not. But of course, if we're subject to GILTI, it's already going to be taxed. So we don't want it to be taxed again when it's distributed out. So what we have to do when the earnings and profits are already picked up under GILTI is we have to back it out of this E&P column, which the technical code section is 952C2. And then you move it to the 952C3 column. So basically, you're moving it out of earnings and profits that would be a taxable dividend on distribution, and moving it to what's called a previously taxed earnings and profits column. So we back it out here, and then we put it in 951 Cap A, which is the code section for GILTI. We put it in this column. So now, next year or this year, if there was a distribution, it would come out of this GILTI amount. Or it'd be next year because the ordering rules would be, well, anyway, if you have a distribution next year, we know you're going to have a beginning balance in your PTEP here, and the distribution is going to come out of that first and not be taxable. And be careful with these because they have all these different PTEP categories. I think there's 9 of them, but there's these other ones where it's called reclassified, and that has to do with this section 956 inclusion that it's a lot more rare that that's going to apply. If you're just working with straight up GILTI or subpart F, which is this one, then you're dealing with these last columns, not these reclassified columns. So once you have the Schedule J, the next thing I go to is Schedule P, which is basically a zoomed in schedule on just the PTEP, the previously taxed earnings and profit. And this is done on a per shareholder basis. So if we had multiple shareholders here, we would actually show each specific shareholder and their share of the PTEP. And here, so there's not the E&P part of this. It's simply just the PTEP and tracking each individual shareholder's previously taxed amount. And you have to do this one in functional currency and in US dollars. And there's one more schedule. I'll go through this one quickly, but this is a newer schedule. I think it came out 2021 maybe, or 2020. But it makes you put the income into groups. This is really more relevant for a U.S. corporate shareholder of a foreign corporation, because when you do the Form 1118 and the foreign tax credit, you have to pool or group your different income items. And that's what this is for, but you still have to fill it out as an individual shareholder. And when you're dealing with GILTI, it goes down into this tested income category. And and you just fill this part out. It's very similar to the I-1 at the end of the day, gross income, directly related expenses, and then it comes up with your net tested income. And then your high tax exception, we'll look at an example of this later, but it shows that here. So if the high tax exception was applicable, you'd mark that on this schedule. All right, so that's everything on the 5471 itself. So once you prepare that, you have all the information you need to determine if they're subject to GILTI. And remember, GILTI is on more of a consolidated basis. So if this person had multiple foreign corporations, we wrap them all up in this 8992, and this is basically the input section. And all of this information comes directly from the Schedule I-1. So you're going to have your tested income, pro rata share of tested income, and then the Q-by amount, and that's how it calculates your GILTI allocated. So you can see if you had multiple companies, maybe there was a tested loss, it could offset this tested income. So it wraps it all up into here. And then on page 1, it tells you what your GILTI amount is. And here it says 21,409. And so this is included in the individual's tax return. And then once you have this, it flows over to your Schedule 1. So there's actually, I think this started last year, there's an actual line item for Section 951 Cap A. And I think, in my experience, you have to be careful. I know with Subpart F, when you put that on the 5471, it doesn't flow to the schedule. And I can't remember now if when you fill out the Schedule 8992, if it automatically flows it over to the Schedule 1. But I wouldn't count on that, honestly. So always double check this to make sure, and you may have to enter it directly on in the miscellaneous income, and then you can code it to Section 951 Cap A so it goes to the right line. Yeah, so that's basically the flow of an individual shareholder that owns a foreign corporation. So in this next scenario where we have an S corporation shareholder, I just want to point out the differences between the two. So basically, I've included this first part here just to show that in this scenario, what we're doing is we have a U.S. S corporation owned by two U.S. individuals, 50-50, and we're filing on their behalf. That way, the 5471 doesn't have to be filed three different times. And one of the, we'll get into more in this in a couple minutes, but one of the, I guess, issues with the 5471 filing in these cases is that the S corporation is a U.S. person for purposes of determining if you have a controlled foreign corporation. But it's obviously not a taxpayer. So you can have a situation where, let's say an S corporation owns 100% of a foreign corporation, but there's 11 individuals that own equal shares of the S corporation. So you don't have any 10% shareholders above that. The IRS has come out and said that Subpart F and GILTI are looked at on an aggregate basis. So if you don't have any U.S. shareholders that own the S corporation, you actually don't have any GILTI or Subpart F, but you still have to file the 5471. It creates kind of a goofy scenario. But in this case, we have two 50-50 individuals. And this is how I fill out the Schedule B in this case, because the taxpayer is actually these individuals. It'll be subject to the GILTI. But the S corporation is a U.S. shareholder, and so are the individuals in this case. So I include them all, but the people that are actually subject to Subpart F or GILTI would be the individuals. And then Part B, or is that Part 2, asks for the direct shareholder, which in this case is the S corporation. All right, so just flowing back through, in this case, we have a Schedule C, a P&L, 24,000 of net income. They don't pay any tax. I think in this scenario, they had an NOL, so they don't pay any tax in Canada. So you have 24,000 of net income. We go to the I-1. we have 24,000 of tested income. So this flows on just like we did in the last scenario. It flows on to Schedule J. So we're going to have, and again, Schedule J is actually done with functional currency, or foreign currency. So, in this case, all of the current year EMP is tested income and potentially subject to GILTI. So we back it out of this regular EMP like we did on the last one and drop it into this PTEP situation. And then we get to Schedule P. And like I said before, this is on a shareholder basis, but you really don't need one for the S corporation because they're not a taxpayer. So you have to include the U.S. individual shareholders in the Schedule P. So we're tracking the PTEP for both individual shareholders in the Schedule P for the individuals. I just put one in here, but we'd also have one for the shareholder number 2. You'd have a separate one. But the main thing to point out here is that the S corporation does not file Form 8992 because it's not subject to GILTI. The individual shareholders are. And actually, the IRS, this was a confusing topic initially because the way Subpart F used to work is that it was actually on a company, like an entity type basis, where the S corporation would calculate its Subpart F and put that on the K1. It didn't matter what the ownership share was at the individual level. They had to pick up their share of the partnership or S corporation Subpart F. They changed that rule to put it on an entity basis. And for GILTI in particular, the K2, K3 comes in to give the individual the information they need to prepare the Form 5470. To prepare the Form 8992 to calculate whether they have GILTI or not. So in this case, we have a Canadian corporation, and this gives them, the individual shareholder, the information they need to prepare Form 8992. And this brings up a potentially interesting situation. I'm interested to hear if Michael does this, or if he does this a different way if he's on the call. But you can have an interesting situation where the individual shareholder, for instance, is not subject to GILTI on this income. So, for example, let's say we're filing this. This is all easy if you're doing the S corporation return and you're doing the individuals, but maybe you're not doing one of the individuals' tax returns. So you don't know, that individual could own 10 other foreign corporations that have huge losses. So this 24,000 flowing through, or his share of it, may not actually subject him to any GILTI, and then you don't actually have any previously taxed income in that case. But you might not know that information, so it makes it tricky to fill out the Schedule P. And I just do it the best I can. If I don't have the information, I fill that out the best I can based on the information I have. But you can see where that can be kind of a tricky situation. But if you're doing all the returns, then if the person's subject to GILTI or not, and it makes it a little easier to fill out those forms. But yeah, the last couple things here, I just wanted to show an example of, there are cases where you just have a Category 3 filing requirement. So even when you don't have a foreign corporation, or controlled foreign corporation, if you have an individual or U.S. corporation that crosses that 10% threshold barrier, either they acquire an interest that gets them over 10% or dispose under 10%. Like in this scenario, this is a client of mine that he moved to the U.S. His family owns this German manufacturing company. All of his family lives in Germany, German citizens, nothing to do with the U.S. He moves to the U.S. and becomes a U.S. person, but he only owns 9% of the business. So originally we're thinking he's fine. We don't have to pick up any of this. We don't have to file 5471. But in his case, these attribution rules kick in to where for Category 3 purposes, he's considered to own the shares of his parents and his siblings in this case. So for Category 3 purposes, he is a U.S. shareholder, and he tripped that 10%. So he had this one-time filing for the German companies. I think in this case it was an India one. They had a bunch of companies. Um, but but yeah, so we had to file this schedule for category 3. And remember, always go back to the instructions to make sure you're including the right schedules. They have a good chart here. I look at it literally every time I do one of these. So category 3, you still have to include your income statement and balance sheet, ownership information, and then the big one is this Schedule O, and then kind of these questions on Schedule G. But the Schedule O is the big one, so we include here. I mean, in this case, the foreign parent company was the direct owner. He was the only U.S. shareholder. And then, so we have the Schedule O, where we would put his U.S. shareholders information here in Part B, and the method of acquisition here. I don't know if in this case it put formation, but there's different things you can put here. So I mean, if they acquired the company, like if they purchased it, you could put acquisition. You'd really just have to apply it to the actual facts of the situation here. And then in Part B, I mean, on the back, you would show the amount paid or given in value. So, this part C, I've seen this done a bunch of different ways, and at the end of the day, I've never seen a problem with it kind of either way. But if it's an acquisition of the stock, like an actual like purchase, I put it in section C. But if they formed the company, it comes into this organization or reorganization of the foreign corporation. So it would go in the section E is where you would put that. In this case, like if the individual became a U.S. person during the year, I can't remember if there's like a drop down box or you just enter it here, but I would probably say like resident or something like that in this method of acquisition. But I still put that in section C because it's not really an organization. It's not really an acquisition either. There's not a great spot for it in that case. But yeah, so that's the Schedule O. And then the very last thing, I'll just show you. I included this one because this is a strategy I use a lot, at least with expat clients that I have, where they live abroad, own a foreign corporation, and maybe they have a non-resident spouse. If they gift shares or if they own the company 50/50 with a non-resident spouse, it's no longer a controlled foreign corporation, so you don't have to deal with GILTI. But Category 4 has a very specific constructive ownership rule where it attributes the shares of a non-resident spouse to the U.S. shareholder solely for purposes of this control requirement, but not for purposes of CFC. So you still have to file it, but it's not it's not subject to GILTI. So you just have to fill out the relevant schedules. And so in this case, you're going to put the non-resident spouse shareholder. You only have one U.S. shareholder here. And the way I do it, and I'm sure there's different ways people do this, but to me, because it's not a CFC, it's not subject to any tested income. It's not subject to GILTI, but it's still Category 4 requires the Schedule I-1. So I just file a blank Schedule I-1. And in this case, they had a loss, but you're going to keep everything in the MP column because distributions will be dividends in this case because none of it's been previously taxed. And there is kind of a goofy rule, or I guess in this case, you put it in the Schedule Q. It's none of these other groups, so you put it in the residual income category. I know that's a lot of information, so if any of y'all have other questions, feel free to reach out to me.